259. I want to bring in InvestorPlace.com executive editor Jeff Reeves to talk about the sell-off that we're seeing right now. Jeff, you know, a lot of investors, retail investors, professional investors look at this type of day as a buying opportunity. What say you?
Yeah, I mean, number one, if you're an investor, large or small, I think you do got to look beyond the day-to-day. We've admittedly seen some big headlines come out with big swings, either intraday or just over a couple days in the market. I think it's important to realize that this is a marathon, not a sprint. We're going to see periods of volatility, but by and large, I think the fundamentals of the stock market itself and based on the American economy are pretty good. The global economy is pretty good. So I think it is important to keep perspective. So if you are looking for a buying opportunity, you know, if you're of that persuasion, which I am, days like today don't bother you. If anything, you know, right. I think there is opportunity there.
Yeah, like in your mind, you know, is Walmart going to really go anywhere? I mean, you know, and look at some of the technology stocks. I know that Facebook is a stock that has been on your radar in the past. I mean, if you see some pressure on Facebook, do you pick some more of that up as well, those technology names?
Yeah, I mean, particularly companies like Amazon. One of the reasons that Amazon always defies gravity isn't necessarily because people are looking at the here and now. They say, yeah, sure, Amazon has all this scale in e-commerce, but Amazon Web Services continues to grow exponentially. Big echo business, who knows what they will come up with next. You know, I think that kind of perspective is really important to have on technology companies. And so with Facebook in particular, I like to look beyond just the day-to-day. The here and now of Facebook is pretty attractive. Honestly, it's a company that throws off a ton of cash. It's got huge scale. But it has also big places to go. And I think that those kind of opportunities, if you can look beyond day-to-day volatility, right. Really allow you to be a successful investor in the long term.
Well, and I want to bring in Phil Flynn is standing by at the CME out in Chicago because, you know, it's funny, Phil, at this time tomorrow, we're going to have the Fed minutes from the last meeting. A lot has changed, of course, since that Fed meeting took place, but there's a lot of pressure, Phil, and speculation on the Fed right now. You know, they could be really the crux of another sell-off if they really start to clamp down, raise those interest rates. They haven't done it yet. They've been pretty timid. I'm going to use that word. But that could change if their hand is forced.
It can, exactly. And if you remember, that Fed meeting was Janet Yellen's last meeting. We have a new guy in charge right now. And so the market, you would expect, based on what was happening in that world of the last Fed meeting, that everything was hunky-dory and that the path would be very clear for aggressive interest rate increases. And now the Fed has kind of set the stage for that right now because they say, listen, as soon as we start to see the employment picture get better, as soon as we see signs of inflation, we're going to have to act, and that's what the market's been seeing, and that in part is what we're fearing today. Now, what's interesting today, you know, all the bad news about Walmart, and that was out early in the day. The stock market was down. They seemed to try to shake it off. But at the end of the day, they just couldn't when they started to see the bond market start to go up. There was nervousness once again about the yields. And when we saw that fear play come into the market, that really got the market shaken up a bit.
It really did. And Jeff, you know, the oil story, you can't ignore the oil story that we've seen, in particular with the movement that we've seen in the dollar. Again, an inflation story. It all goes back to inflation and what's happening with the U.S. economy and to the consumer. But with the oil story, at least, that seems to me to be kind of something that isn't changing. We're still above $60, 61.55 as a matter of fact. I know that you've been looking at some of the drilling operations, some of the petroleum companies to kind of make a stock play there.
Yeah, I mean, so the hard reality for the energy sector was after energy prices crashed, and we saw, if you remember all the talk about the junk bond bubble and 50% of energy companies were supposed to go bankrupt. It never really happened. There was some pain, but I think a lot of companies adapted to that. And one of the companies that I'm looking at right now, Anadarko Petroleum, actually took it on the chin for a while. It had to cut its dividend. It had to cut jobs. Things weren't so great. But now it adjusted its operations to the point where it can be comfortably profitable at $50 oil, and every $1 per barrel above that is an extra $100 million in net operating cash. So at $60, you don't have to be a math major to see that's $1 billion extra dollars for this company.
Right.
So a lot of oil companies like that have figured that out where, look, they don't have to survive an $80 oil environment. They can survive at 50. And if we are seeing inflationary pressures and we are seeing a kind of cyclical recovery either at home or globally where there is increased energy demand, I think it's going to stack up pretty well for these unloved energy stocks, which, by the way, tend to take it on the chin harder than some of these other companies during periods of tough times for the stock market because people have been burned by energy in the past. So I think there might be some bargains there.
Phil, oil is your sweet spot. I mean, I know you've got a lot to say here, but, you know, know, one of the things I think has been bullish for oil and for the sector and for the U.S. economy has been we've got a record number of rigs that are open and producing here in the United States. Some people say, well, that's not really a global story. I think it is.
I think it is a global story. Listen, the shale revolution has changed the world, but we have to be careful to not look at these rigs and assume that increase in U.S. production is going to meet growing global demand. And there's a lot of people that are saying, hey, the U.S. is the new shale swing producer in the world because of U.S. shale, and that's not the case. They can't raise production fast enough or low enough. It's a great story, but right now, Cheryl, the way the globe has been growing, we're going to need every drop of shale oil we can get because the demand growth in the world's been incredible. And your other guest hit the nail on the head. The energy sector was beaten, it's bloodied. They cut back spending probably too much, to be honest with you, and that's why I think their profitability is going to look very, very good. Once we get past the stock market sell-off, look at oil. It was one of the best markets that held up today. Gold was down, silver was down, platinum, palladium, all under pressure, but oil held in there because there's something going on in the oil market. It's called demand, and that's keeping those prices strong.
Right, and you've got the Saudi story on the other side, which I think has helped the United States.
Yeah.
I want to bring in Teddy Weisberg down on the floor of the New York Stock Exchange. And Teddy, I want to talk bigger picture with you because, we've been through these volatile days before. Last week was the best week in 5 years for the market. So
Yeah,
this can turn on a dime. And I know you're used to this. You've been on the floor for so many years.
No, you never get used to it. But anyway.
No, you're still shaking a little bit. Okay. Yeah. Even Teddy Weisberg can shake in his shoes. That's good to know. But I tell you what, overall, what we have seen, in particular since the election of Donald J. Trump, what we have seen since the inauguration, tax reform, has been companies moving money back to the United States. We've seen a bullish story, a bullish earnings story, a hiring story. The market doesn't seem to be kind of playing off of that. Today, are we missing the bigger story?
No, I think I think you hit the nail on the head as far as the big picture is concerned. But, the gorilla in the room, the 800-pound gorilla, is and always will be the Fed. And they telegraphed 12 or 18 months ago that we had this shift in the direction of interest rates. So they went from a period of being accommodative for 7 or 8, 9 years to neutral, if you will, now to being slightly restrictive. Now, maybe they're doing it with kid gloves, but it's still restrictive. And interest rates clearly are moving higher. The 10-year is working higher. The long bond is working higher. And we have a stock market that's basically, to some degree or another, ridden the backs of zero or very low interest rates for 8 or 9 years. So the shift at the Fed, even though it's subtle and they're doing it very gently, the fact is it does create headwinds for the market. The flip side is, with all the things that have come out of Washington, the tax bill primarily, it's going to be terrific for corporate earnings. At the end of the day, it's corporate earnings that will drive stock prices. So perhaps we give a little back here, which is natural, even though it's disturbing and it's painful because we've been on a long ride. But at the end of the day, it's going to be corporate earnings, and it's going to be a reasonably accommodative Fed, even though restrictive, and I think the markets will work higher. We just have to get through this period.
Just to get through the day. I mean, and to your point, earnings season is just now winding down overall, except for some of those fourth quarter hits that companies took because of repatriation from overseas for cash, which, but that's a one-time story. Overall, these companies have said, we are doing well. The Walmart story, of course, we can't forget today. Walmart saying it was not a great holiday quarter, but they're Walmart, so we shall see what happens with that stock. And we were also talking about the financials earlier and the banks with Charlie Gasparino. I want to bring back in Charlie into the conversation because, again, to the point, financials a huge sector for the markets. It's in everybody's 401k most likely, and these banks are going to do well in this environment.
They should. Where's Goldman trading at today? Did I bring it up a little bit?
Yeah, well, you talk, bring the markets back, and I'll bring up Goldman Sachs. How's that?
It's down about 1%. Here's the thing. I want to agree with everything that Teddy just said. The notion that we're going to have better corporate earnings, so we're getting a massive corporate tax cut, that the economy is fundamentally fine, that interest rates might spike a little bit, but nothing out of the ordinary. But there's a flip side to that, which I'm hearing a lot, and it's this. It's that, the economy's fine. Corporations might do better. But if we don't get a big bang for the buck in terms of GDP for these tax cuts, that will widen out the deficit immeasurably. And at that point, you can have really high interest rates, and not just the marginal stuff we're having now, but something that spikes pretty dramatically because the deficit widens out. And those higher interest rates are enough to snuff out both the economy and the markets. And that is kind of what some of the fears underlying in this market right now. And it's, listen, I tend to be, I'm a supply sider. I like tax cuts. I think, you know, besides the fact that I'm, you know, libertarian and I think it's my money, you know, I think it works. You know, I think now, but we got to see how well it works. And, you know, if it doesn't work, if the White House is wrong and the deficits blow out wider than they're suggesting, I mean, you got to look at interest rates. And, you know, and here's the other thing. You don't have the Fed anymore. The Fed is not accommodative. Right. I mean, I can't imagine they're going to do another QE to prop up rates if they have to issue more debt, like we essentially buy it from ourselves. I mean, these are some of the things. Now, how this plays out and when, I mean, who knows? I mean, you know, it could be the next 3 quarters, you know, and we get volatility in between them, which we're seeing today, which is pretty good. I mean, it's a trader's market. And by the way, Goldman Sachs should do really well today. I know the stock's down a little bit, but let me tell you something. This is the market that firm is built to capitalize off of versus any other firm. Lloyd Blankfein was hammered hard by a lot of analysts. Dick Beauvais, one of them, for not retrofitting the Goldman Sachs business model to reflect the sort of different climate, the low volatility climate that we've seen over the last couple of years. Something's happening now. Now we're getting volatility back.
I'll tell you what's happening. It's the Charlie Gasparino effect on the market. Since you've been talking, Charlie, look, we're now down only 232 points. I mean, that just happened as Gasparino was actually talking about the banks. There you go, Charlie.
I'm just such a tout.
You
what
are.
Can
You
I
are.
tell
Look at the Dow 30. Look at the Dow. And actually, we've got a couple of names that just went green. JP Morgan Chase, again, Charlie Gasparino effect. That stock just went in
Did Goldman go green yet?
I'm half kidding. Home Depot, that's back in the green. Visa. Remember, Home Depot came out with earnings this morning, folks, and they had a very strong quarter. Home Depot you can equate to the U.S. economy. As Home Depot goes, home improvement, people buying homes, redoing homes, whatever, that's the Home Depot story. Visa, consumer spending. And then you've got Amex, American Express, Intel. The rough story, of course, of the day is Walmart. That's the consumer. And I also want to bring in Charles Payne right now into all of this because, you know, we were talking about this early, Charles, and I think you're kind of on this page, that when you see a sell-off like this, a lot of smart investors look for buying opportunities in moments like this.
You're absolutely right. I can tell you, Cheryl, over the last 20 or so years, my own subscribers, every year they get better and better at when these things happen and calling up and asking, hey, what do we buy rather than do we sell everything and head for the hills? So, you know, there's no doubt about that. And this sell-off is really intriguing today because there were pockets of enormous strength and optimism. We saw the semiconductors doing extraordinarily well. Lam Research, Micron, some of those names up really big. Even you just talked about Home Depot. It is sort of a proxy for the U.S. economy. It is also just another one of these companies that's doing extraordinarily well. One of the keys and the reason why it's done so well today, pricing power. Their average ticket went up 5.5% year over year. So their prices went up and their volume went up. They didn't lose any customers. It's an amazing 1-2 punch when any company can do that. Of course, we know what's happening with Walmart. Disappointment on online sales. I think that's a one-off. I don't know that that's indicative of the economy or even a broader market, though.
That's a good point, you know, Charles, because, you know, don't count out Walmart. They're making a lot of investments, of course, in getting their online game together. It just didn't get really in time for the holiday quarter. I want to bring back in Jeff Reeves. You know, again, same question to you that I just had to Charles. This is the buying opportunity that folks like you look at.
Yeah, definitely. And I mean, you know, we kind of talk around these bigger issues, but I think it's also important to kind of take a deep breath and have some context. You know, there have been plenty of times in history, actually most times, when the stock market has gone up as rates have gone up too. So I think that's important for folks at home to kind of realize that it's not this kind of dichotomy between either stocks go up or rates go up. There are plenty of periods of time where we've seen higher interest rates where the market has done very well. And the reason for that is, why do you raise rates? It's because employment is great. Unemployment rate is very low and prices are rising. rising because companies have to pay their employees more and wages are going up. It's a virtuous cycle. So, we talk a lot about rates because I think people see their credit cards or their mortgages. They have fears about buying costs. But it's ultimately a really good story in the long term. And when you can look past days like today or look past the idea that, maybe for a certain individual, a house may cost more in 2019, the reason for that, the dynamics of it, the economy behind it is actually not that bad. It's a good thing.
Yeah,
and I think you need to keep that in mind.
It's not the early 80s. Late 70s, you had gas lines across the country. Early 80s, you had mortgages. Your mortgage interest was 14, 16%. Nobody talks about that anymore. This isn't that environment. This is actually a much better environment. I want to go back to Phil Flynn on the issue of the Fed, obviously. And are we that interest rate sensitive, Phil? We've been hearing from the Fed for months, actually 2 years. We knew this was coming, and none of us should be surprised by the fact that the Fed's going to start raising rates this year, maybe one more time than we expect, but.
No, in fact, we predicted well before the market got freaked out about it that the Fed could have to raise rates 4 times. Now, the bottom line is that the Fed telegraphed this beautifully. And it did seem to be when there was a change at the helm, when Janet Yellen left and we brought in a new guy at the Fed, it created some concerns. There was some talks about overvaluation. But what we're going through here is a healthy correction. This market had gone up too strong, too quickly. We shouldn't be fearing higher interest rates. We should be welcoming them. Borrowers have been dying for higher rates. I know the commodity exchanges, they love to have higher interest rates because it's good for their bottom line. And there is pricing power. I go back to what Charles said about Home Depot. That's something we haven't had in the economy for 10 years. Pricing power. People are able to raise prices. That's a good thing, and that's going to be good for the economy as a whole, despite the turmoil of the last couple weeks in stocks.
That was a good point that Charles made as well. And I want to bring in Jerry Willis from the floor of the New York Stock Exchange. We've got 5 minutes to go until the bell rings. Certainly the big story is Walmart, but there's some brighter spots you're looking at, Jerry.
So, look, what we're seeing here, tech, the only sector really in the S&P that's been in the green all day long. And we're seeing big companies, Google, Microsoft, Amazon, Intel, enjoying gains here. The overall sector up about 0.6%. As you know, this sector did better than others last week. These are growth companies. These are companies that have a plan going forward and into the future, and I think investors like that right now. If you were to drill down, say, on Amazon, this is a stock that has simply refused to go down in a lot of these sell-offs. It's been the one stock, certainly, that so many investors have wanted to stay on board. But all of these companies really doing well here, and you mentioned financials doing well. I have to tell you, technology even beating out financials today as we see these companies for a variety of reasons, because they're remaking the way retailers sell their goods, because they're remaking the way drugs are sold in this country. It seems like every category now getting involved in technology as we see this sector really go to town. Back to you.
Yeah, Jerry, it's good to see, obviously, that that's the future, really is technology, and investors know that. Charlie Gasparino, final thought to you. We've got about 3.5 minutes to go to the bell rings.
Maybe I can get the market back up.
Please.
Look, no, I think the point about higher interest rates is well taken, that moderately higher interest rates is good, and it points to a growing economy. Where higher interest rates get nasty and where this can get out of control is if these tax cuts, again, say it again, don't produce the type of growth that's needed. More than 3% is clearly something that needs to happen. And if that doesn't happen, you don't get a big bang for your buck in terms of corporate earnings, number one. But number two, you have a widening deficit. And when you have much wider deficits, you obviously have to sell more debt. To sell more debt, you have to put higher interest rates to attract investors. And and we're not just talking about modestly higher interest rates based on growth. We're talking about a spike. And that's some of the fears that's in the market. If we do have that, all bets are off here. I mean, then that's it for that could be it for the bull market, and we could, obviously, if you follow that doomsday scenario, it leads to an economic slowdown. I'm not saying it's going to happen. I think tax cuts actually pay for themselves, but there is that theory out there, and it's not held by lunatics. I mean, we're talking about David Stockman and a lot of other smart people, that's their doomsday scenario.
Yeah.
So I would just say if you're an investor,
Well, David Stockman's, he's definitely got his thoughts about the doomsday.
Yep.
I'm glad you brought that up with regards to Stockman's. Real quick, I want to go to Charles Payne before we hit the bells here. Charles, all that concern about the economy and really about the Fed, is it overblown or no?
I think it's absolutely overblown. The last time we had a repatriation tax, George Bush, the fourth quarter of 2004, the first 3 quarters of 2005, the last 2 years, America grew more than 3%, 2004, 2005. Cisco last week said they're bringing back $67 billion. That's $250 billion with Apple. Already, we're seeing more money coming back. I'm pretty confident. Ride these waves out. Do what you have to do. But don't get shaken out. Don't get spooked out. 3% never crashed. 3% yield on a 10-year never crashed the stock market.
Jeff Reeves, I've got a minute and change to go. Final thoughts?
Yeah, I mean, I think everybody's talking the same story here. I think that there are ways where this does go sideways, but there's a whole lot of daylight between now and then. And so, if you are an investor, it's a cliche for a reason, take what the market gives you. I think we've seen buying opportunities in the past on pullbacks. I think this is one right now. Whether or not there's a long-term catalyst that's going to push everything down seriously or cause a recession, I mean, I don't live in those worlds of what ifs. I'm just going to take what the market gives me. And right now, I kind of like the valuation in a bunch of stocks. I think it's a stock picker's market. Pick some stocks here.
All right, final word to Phil